Nitin Jain, Head of Retail Capital Markets at Edelweiss Financial Services, joins us. Nitin, good afternoon to you. Thank you for joining us. What do you make of today's consolidation? Healthy, or today's consolidation is some kind of an indication that momentum is breaking down?
No, actually, if you see the index, it's hardly 10-15 points down. So you can't read too much into that. We still believe that the momentum is quite intact, and our view has been a long bias for the last 2-3 weeks. And it continues to be so, unless something more dramatic happens. We are advising clients only to buy at dips.
Why do you think momentum is intact? Because globally also things are stalling a bit, with the exception of some beta stocks, maybe some banks and metal names. Nothing is really moving from strength to strength.
No, if you are going to look at the daily chart, probably you're right. But if you look at just the way stocks have panned out over the last couple of weeks, I think still there's a lot of action that's happening in the mid-cap space. There are select stocks which are moving 8-10% in a day. And if you go back in history and you just go back 3 months earlier, hardly you would see any kind of a participation from the broader markets. And it was whatever was happening was largely limited to the large caps whenever the stocks would rally. This is the first time after a very, very long time that we are seeing, stocks across sectors, across mid caps, large caps, small caps, across the categories are moving. And we think that's a reasonably vibrant market right now, and hence see no reason to believe that the momentum is broken.
Nitin, what is it that you would do with the sugar pack now? Because it seems all that could go wrong has gone wrong. Does sugar become a buy?
See, most of these cyclicals, particularly commodities, I think are very risky bets to get into from an investment point of view. Generally, you have to make trading calls on these stocks, and from a pure trader's point of view, if you have maybe a 3 to 6 month kind of a horizon, you can take a trading call. But I would still be very, very cautious getting into these kind of stocks.
Right. Nitin, how exactly should investors approach technology now? Because rupee clearly is no longer volatile, and the big upside for technology companies for the quarter gone by came largely because of a weak rupee.
That's absolutely right. We are still bullish on IT stocks from a 1 year kind of a horizon. If you see some of the stocks like Infosys, like HCL Tech, a lot of these stocks are trading between 15 and 17 kind of multiples over the next year. Though they are no longer as cheap as they used to be maybe around 6 to 7 months back, but they're still reasonable valuations. And if you go slightly lower down the chain and look at some of the mid-cap stocks, you'll find a lot of stocks which are showing positive signs now. Growth is coming back, margins are intact and kind of rising. So there are at least 2 or 3 stocks that I can name, stocks like Mindtree and all, which are trading at 9 to 10 kind of multiple. And at that level, I think there is very little to lose unless something dramatic happens to the rupee.
Nitin, what's the view then on banking? Because a whole lot of experts are turning bullish on the prospects of PSU banks, the ones which have posted improved asset quality this quarter.
See, now again you have to distinguish. When you say you are bullish, are you bullish simply because there is a theoretical arbitrage available in terms of valuation gaps, in which you can take some trading bets, maybe in stocks like SBI, maybe in a stock like Bank of Baroda, you can play for, that averages probably are around 0.7, 0.8 times book, and some of these stocks have gone to 0.6, 0.7, and you're playing that kind of a, catch up in terms of valuation. But if you really think from a pure investor's point of view, and you say, I have a 3-year kind of a horizon or a 5-year kind of a horizon, I would still stick my neck out and say, you should rather focus on some of the better run banks like, ICICI Bank, HDFC Bank, Axis Bank. The kind of shareholder value that they can create over the next 3 to 5 years is probably much, much more than what, some of these stocks can create.
Is it time to revisit metals as a group? The data from China is looking strong. Global growth is making a comeback. And if China gears up once again, there could be a big revival in metal demand.
Absolutely, absolutely. I think, though it's still fraught with risk, whether the actual demand will turn around or not, but I think the entire market is betting on the same, and with a reasonably good logic behind that. So we are also in that camp where we think the probability of a turnaround is reasonably high. And secondly, if you look at some of the valuations, I think the valuations are reasonably cheap, despite the fact that there has been a 70-80% kind of a rally in some of these stocks. But from a historical point of view, these stocks are reasonably cheap. Stocks like Tisco and all, if things turn around, I think I will not be surprised to see the stock going up around maybe 50-70% further from these levels.
Let's look at the defensive end of the market, and when I say defensive, the traditional defensive end of the market, HUL, ITC, they're taking it slightly easy. Do you think the springtime for FMCG is over?
Again, I mean, if you are betting on the next 3 to 6 months, and if our view is largely positive, and if it's a risk-on kind of an environment, I kind of agree with you. I think some of these defenses will take a backseat, and maybe they will underperform the market. But if you just think about a portfolio, and then it's very difficult to not have stocks like ITC and Hindustan Levers in any large investor's portfolio over a 3 to 5 year kind of horizon. But if you're a trader and if your horizon is 3 to 6 months, I would kind of agree. I think some of these defenses might underperform.